Nigeria's tech ecosystem has exploded onto the global stage, with unicorns like Moniepoint, Flutterwave and Paystack making headlines. $1.2 billion in 2022 venture capital funding to Nigerian startups reached, making it the continent's most funded tech hub. But beneath the success stories lies a complex investment landscape riddled with unique challenges that can make or break your portfolio. While the opportunities are massive, the risks are equally significant and often misunderstood by diaspora investors. In this video, we analyze some of the most common investment risks and share practical tips to mitigate them. Regulatory uncertainty and policy volatility. 1. Nigeria's regulatory environment changes fast. From foreign exchange restrictions to sudden policy reversals, the government's approach to tech regulation remains unpredictable, and this has posed as a significant risk for many investors. One of the most recent cases of this was the Central Bank of Nigeria's (CBN) sudden ban on cryptocurrency transactions in 2021, which blindsided fintech investors. To mitigate such challenges, investors must establish relationships with local legal experts who understand both technology and Nigerian regulatory trends. Develop regulatory scenarios and stress test your investment plan against each scenario. Avoid concentrating investments in sectors facing active regulatory scrutiny. Infrastructure deficits and operational bottlenecks. 2. Nigeria's infrastructure challenges go far beyond unreliable electricity. The ecosystem suffers from inadequate internet penetration in some urban and rural areas, inconsistent payment infrastructure and logistics networks that struggle with last-mile delivery across diverse geographical terrain. Unfortunately, many Nigerian startups build brilliant solutions for infrastructure-rich environments, then struggle to scale in infrastructure-poor realities. A food delivery app that works perfectly in Victoria Island, for instance, may completely fail in secondary cities where addresses don't exist and mobile money adoption is low. How do you mitigate against this risk? By conducting infrastructure-first due diligence. If the startup solution requires infrastructure that doesn't exist in 70% of their target market, the scalability story needs serious scrutiny. Favoring business models that work around infrastructure constraints. Look for founding teams with deep operational experience in Nigeria's challenging environment. Account for the hidden costs of infrastructure workarounds in your valuations. Currency volatility and capital flight restrictions. 3. Naira has lost over 60% of its value against the USD in the past 5 years. But currency depreciation is just one piece of a complex puzzle that includes multiple exchange rates, forex scarcity, and restrictions on international transfers that can trap your capital indefinitely. A startup you invested in may be showing 300% growth in Naira revenue but is actually declining in USD terms. Currency volatility makes it nearly impossible to accurately track real performance, compare valuations, or plan exit strategies. Here is how to manage these risks. Structure investments with natural currency hedges, and favor companies with USD revenue streams. Don't rely solely on international exits. Instead, develop relationships with local acquirers, consider secondary market options, and structure deals with multiple exit pathways. Consider investment vehicles that can hold multiple currencies, reducing forced conversion at unfavorable rates. Investing in Nigeria's tech sector has a lot of opportunities for significant returns, but only investors who are able to effectively mitigate against the risks will reap the rewards. Get actionable insights on any tech sector before going forward with your investment. You can't always avoid risks, but you can mitigate them with adequate research and market intelligence. Let us do that for you today. Click the link in the description to get started.